Hello and welcome to Sovereign Financials, financial education for everyone. Hi guys, welcome back to Sovereign Financials. This week we're going to talk about what yield curves are, what a yield and curve inversion means, and what it could hold in the future for us if the yield curve does actually invert. The first step to this whole thing is when we talk about normal yield curves. So a yield curve is essentially looking at Treasury notes, and what Treasury notes are is how much the government will pay you for lending them money. These Treasury notes, essentially these loans, have different years on them, so they can mature in different amounts of time. So you can loan the government money for 1 year, 2 years, let's say 5 years, 7 years, 10 years, all the way out to 30 years. And you can even loan them money for months at a time. Let's say 1 month, 3 months, 5 months, etc. The yield is the interest rate that they will pay you for loaning them the money for that amount of time. Now, in a normal environment, the shorter the amount of time that you loan somebody money, the less risky it is, and therefore the lower the interest rate they pay you. Let me give you a quick example. If you have a friend Bob and you loan him $10 and you say, hey Bob, pay me back tomorrow, versus hey Bob, pay me back in 1 year, there's a much more likely chance that Bob will pay you back the $10 tomorrow than there is if Bob borrowed the money for a year and he owed you $10 in a year, right? Who knows where Bob will be in a year. So to kind of represent that risk in number format, if you loan the government money, let's say for 1 year, this is just an example, the government will pay you an interest rate of 1.1%. If you loan them money for 2 years, they'll pay you an interest rate of 2.3%. Let's say 10 years, they'll pay you an interest rate of 3.5%. And then the risk, if you loan somebody money for 10 years, it's almost the same amount of risk as loaning them money for 30 years. If they're going to pay you back in 10 years, they'll probably pay you back in 30 too. So it kind of tops off. So at 30 years, they'll pay you 3.7%, let's say. So it is still an increase, but it kind of like tops off at the end, right? It kind of flattens out. So in a normal environment, the yield curve kind of increases like this. It makes this shape like that. And this is a very normal way that loans and the environment, the market works. Now, there's two other types of yield curves you can have, right? So one of them would be a flat yield curve. So let me just move on to the next slide here. In a flat yield curve, this is not a typical place where things stay. This is more of things moving from either a normal yield curve to an inverted yield curve, which we'll talk about next, or from moving from an inverted yield curve to a normal yield curve. And what happens here is the long-term interest rates either are staying where they're at or they're coming down. But more importantly, it's the short-term interest rates are starting to go up. So in our last example, the one year interest rate was only 1.1%. It was right here, and now that's moved up. And then you'll say the 2 year is being moved up, and that kind of makes this like flat appearance here. And what you're saying is that the short-term risk, that there's a chance that whoever you're loaning money to will not be able to pay you back in the short term, but in the long term, everything will probably be okay. So this graph kind of starts flattening out a little bit. And risks that could cause short-term interest rates to go up would be stuff like either hyperinflation. If inflation starts going up, people are going to want bigger interest rates in the short term. If they think that the inflation will stop and then the long term will be okay, then they won't require higher interest rates out here. Or if they think a recession is coming up, they'll want higher interest rates. Or if the Fed is raising the interest rates, then they'll want higher interest rates right now as well. All right, so now let's go ahead and move to our inverted yield curve. Let's see here. There we go. So the inverted yield curve, this is a very abnormal environment, right? What you're saying is so here at 1 year, the interest rate is 4.2%. And then if you loan the money for 2 years, it actually goes down to 3.1%, right? And then this number keeps going down and then eventually flattens out. So what you're saying here is that, hey, if I loan you money for a short period of time, there is a higher risk of you not being able to pay me that money back compared to long term. I think long term you're going to be fine, but in the short term I think this will be an issue. And usually this deals with recessions, right? So once again, this can happen if a recession's coming around, or if inflation starts picking up. Let's say inflation hits 3.5%. Well, then I don't want a bond that's only going to pay me 2%. I want you to pay me a higher interest rate. Or if the Fed starts raising interest rates because, let's say, inflation's getting out of control because yields have been too low for too long, then the Fed will start increasing the short-term interest rates, which then causes this inverted yield curve. So that is what a normal yield curve, a flat yield curve, and an inverted yield curve look like. Now let's talk about the implications of these. So specifically of an inverted yield curve. So the first thing I want to show you here is it's kind of a complicated, so it's 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. Basically, what we call this is you call it the 10-year minus the 2-year, okay? And remember, these are interest rates, right? So let's say at 10 years, let's pretend that 10 years will pay us 5%, a 5% interest rate for 10-year loan. Whereas the 2 years, let's say we loan the government money for 2 years, they will pay us a 3% interest rate, right? That would be a normal yield curve. What you do is you take the long-term interest rate, which is 5%, and then you minus the 3%, so you get 2% difference. So 5 minus 3 equals 2, right? And that is what's being plotted on this graph here. So that's a nice healthy number, right? You were getting 5% for loaning 10 years, and you're only getting 3% for 2 years. That makes sense. And then you get a number 2. So let's look at this graph here. So here's a 2. So things would be at the 2 is like here, here, and then anything in here. And that's a nice healthy environment, okay? Now, if you look at these gray lines here, you see between the reds, these gray lines, these are recessions, okay? So this is where recessions happen. So, 2000 here, this is the dot-com bubble. This is the 2008, 2009 market crash, 1990 recession, and then there's 2 small recessions in the 80s. Now, what happens if the 2-year maturity rate, the 2-year interest rate goes up? So let's just go ahead and we're going to go ahead and clear this off here and draw this again. So let's say the 10-year pays 5%, and then now the yield curve is inverted. Let's say the 2-year, the interest rate's gone up to 5.2%, right? So this is again an abnormal environment. We're saying that, hey, I think there's a risk of a recession coming around. So if I loan you money for a short period of time, like 2 years, I want a 5.2% interest rate. Whereas I think in the 10-year time frame, I think you'll be okay, right? So 5 minus 5.2 gives you a negative number. So you have negative 0.2. And this is an abnormal environment. So here is 0. And let's look at the differences. So minus 0.2. So that would, if anytime it hits a negative number, it's like here, here, negative, negative. So 10 minus 2s are negative, 10 minus 2 is negative. And what's more important is the implications of these things. So if you look, 10 minus 2 went negative, and then you had a recession. 10 minus 2 is negative, you had a recession, right? The 10 minus 2 is negative, and then you have a recession. 10 minus 2 goes negative, and you have a recession. 10 minus 2 goes negative, and you have a recession. I mean, you get the point. Now, if you look at where we are right now, right, we're not quite negative here. If you can take a look there, it's not quite below the line yet, which would be like right here, but it's coming up, right? We'll probably hit negative number right there. And then the idea is you're going to have a recession like right there. So this is why having an inverted yield curve is such a good indicator of an upcoming recession. I mean, it's been good since the 1980s, and it's just kind of without doubt, like every time it hits negative, you have a recession, negative recession, negative recession. And then when this hits negative, we would probably have another recession. And of course, the experts actually say the same thing. So this is the Federal Reserve Bank of St. Louis, which is just one of the branches of the Federal Reserve. And then this is their article here. In early May 2018, the Wall Street Journal asked professional forecasters to predict when the next recession would begin. Nearly 6 in 10 answered the next recession will begin sometime in 2020. And the reason why is because they're looking at this graph here. And they got cut off here at the bottom, but you can just trust me that they use the exact same graph that we were looking at. And they went all the way back to the 1950s that showed how the Treasury negative yield curves, the 10 minus 2 went negative, and then there'd be a recession there. So if you want to look at what the actual Treasury yields are at this time, you can go to treasury.gov, and they post their numbers on a daily basis. So here, as of 4/18/2019, you can look at all their interest rates. So if you look here, the 2-year is 2.38%, and the 10-year is 2.57%. So if you take the 10-year and you minus the 2-year, you get 0.19. So it's still positive, but it's a very small positive, right? And if that becomes negative for a couple months, then we'll have an issue. Otherwise, though, take a look at this. So if you loan the government money at 1 month, the interest rate you'll get is 2.44%, right? But if you loan it the money for 3 months, you get a lower interest rate, 2.42%. That's an inverted curve there. If you compare the 1 month 2.44 to 2 years 2.38, you get a higher interest rate for loaning the money at a shorter period of time than you do for a longer period of time, which means that the 1 month all the way out to the 2 years inverted, and it actually goes further than that. The 1 month, you get a higher interest rate for loaning them money in 1 month than you do for loaning them interest, or giving them a loan for 5 years. That's 2.38%. So the yield curve is starting to invert, but it's not inverted all the way out to the 10-year period yet, but that's kind of where we're headed. All right, let me show you one last thing here before I wrap this video up. By the way, guys, if you want more information on any of this, if you go over to sovereignfinancials.com, I'll have a link down in the comments. We post newsletters twice a week. It is subscription based, but we give a lot more content on all this, and you can get a lot more details in that subscription. Our newsletter that was just released in the mid-month newsletter, so it's twice a month, like in the first and then in the middle of the month. We give way more details, and we talk about some investment strategies you can do to kind of prepare for a recession or even prosper during a recession. Okay. So back to this one here. I love this specifically. This is a dynamic yield curve. Basically, it gives us a chart of the stock market, the S&P 500, and it also allows us to move interest rates, see what the yield curve looks like at the same time. It's called stock charts. Okay. So let's go ahead and close this. So this is where we are right now. This is in 2009. Actually, this might be late. This is April 2019 right here. Okay. And if you look at, this is the yield curve. So this is, saying 2.3 for the here, but if you look, it's kind of inverted in the beginning, like we know, and then from there it kind of kicks up a little bit. But overall, right, that's a pretty flat yield curve. Okay. That's not a good sign. That's an ominous sign there. And we'll get to that in a minute. So let's go and close this. Let's go all the way back to the 2000s. So this is like before this. This is before the dot-com bubble. And if you look at the yield curve starts here, and it kind of has like that normal, like appearing yield curve that I showed you, right? It's not the best, but it's there. Now let's go fast forward here, and we get to the top of the dot-com bubble. So right here, this is the top of the 2000 dot-com bubble. And you look, the yield curve is inverted, right? This is an ominous sign the market's going to crash. Even though we haven't crashed yet, this is a leading indicator by 2 or 3 months. Now, if we go forward and the market starts crashing, and now look, we're at the bottom of the market. So we're at the bottom of the dot-com bubble, and look, we have a nice healthy yield curve, right? Excellent time to start buying stuff up again. And you can take a look here, is the next thing to come, sure enough, is a rally, right? So that would mean the yield curve is a great predictor for both being able to buy near the bottom and then start selling near the top before the yield curve becomes flat or inverts. Now, let's fast forward in time. We're going forward. We're starting to hit the 2005-2006 market bubble. And if you look here, the yield curve was normal, and now we start to flatten out. So let's take a look here, right? This is in 2006, February 2006. And look, the yield curve is flat and maybe even just a little bit, inverted here at the end. This is a flashing a warning sign for us in 2006. Okay, so at this time would be a good time to sell. And if you remember, in terms of housing, this was actually near the top. In terms of the S&P 500, it keeps on going on for a little bit more. But that's where we're right here, right now, and we're getting a warning. Just keep going forward, and look, it is flat. Right, so here we are at the top of the bubble. It's still super flat. It doesn't full-blown like invert this time, but I mean, you shouldn't be holding stocks or everything at this time. It's basically telling you, here comes a recession, you need to sell. And if you listen to that, you'd be doing well, because then the market crashes. And then look, at the bottom of the market, right, we're at the bottom of the market again after the 2008-2009 market crash. Once again, we have a nice healthy yield curve, right? A great time to start buying. And sure enough, right, the market does start going back up again after this. So start going in time. And if you look here, look at this bottom corner. The Fed pinned the negative, the interest rate, the short-term interest rate at basically 0.25, essentially 0. So this isn't going to move a lot. But if you look, once again, the yield curve is nice and healthy again. So let's start going forward in time, forward. Still normal. And then the Fed starts, increasing interest rates. And if you look, just start here, right? Like, it's still kind of normal, but at the same time, it's also starting to flatten out a little bit, okay? Let's go forward. And if you look here, this is worrisome, right? We have essentially almost a flattened yield curve. It's a little up, and then it's basically flat. Let's keep going forward here. And then here we are now. So here we are now. In the very beginning, we have a little bit of an inverted yield curve, which I showed you on the treasury.gov website. And then from there, it kind of goes up a little bit. But this is pretty worrisome, right? This is almost essentially flat again. And if right here was the dot-com bubble, this is the 2009 housing bubble, and this is the bubble that we're in right now. We're much closer to the end of a business cycle, right? We have a flat yield curve, we have super high markets, than we are to the bottom of a market, right? We're definitely not at a bottom. You can see that, right? Because this is the difference. So the question is how careful should you be investing right now? Should you be going full blown in the stock market? Probably not. This thing, you would want this thing probably to crash first. You'd want the yield curve to start flatten out, or sorry, to become normal again, which would be like right around here, let's say, and then you could start riding the next wave up. So once again, guys, if you want to check out the newsletter, it's sovereignfinancials.com. I'll put the link below. If you guys liked the video, I would really appreciate if you hit the like button, subscribe, and hit that little bell next to the subscribe button if you want to be alerted when I have new videos. All right, guys, thanks, and I'll see you next time.